Of course, this is not financial advice and for entertainment purposes only.
Investors welcome a very special guest, Mr. Edward Eglinski, who is a managing director at Direxion ETFs and is an industry veteran. Now, in this video, we're going to be talking about everything leveraged and inverse ETFs, how he is feeling about today, and how are you feeling about just being on the podcast and the channel?
Excited to be here. Fall is almost upon us.
Can you provide a brief background on yourself as well as what is Direxion ETFs known for?
As you can tell by the hair, I've been in the business for about 30 years in varying senior roles in liquid alternative investments and traditional alternative investments as well. I've been at Direxion for the last 14 years, holding different management roles here, most notably the last 6 years with global sales and heading up alternatives. And really, it segues throughout my career. Direxion really is an alternative ETF provider, providing trading tools for the active trader that wants a magnified view, whether they think the market's going up, a bullish view, or if they think the market's going down, a bearish view. So we have a broad array of products with different leverage points ranging from 3x to inverse 3x to as little as inverse 1x if you just wanted to take the opposite direction in a market for a single day. We have the non-leveraged inverse as well.
Can you explain what leveraged ETFs are as well as what inverse ETFs are and how they differ from traditional ETFs without leverage or I guess without inverses?
Yeah, sure. Well, first off, leveraged and inverse ETFs provide a magnified exposure to an underlying benchmark, whether that's an equity benchmark. We have some tools if you wanted to trade interest rates, fixed income benchmarks as well, and even leverage and inverse single stocks. The key is that these are designed for short-term active trading. And for those individuals that are traders that want to monitor their daily activity and have a short-term trading view, these are the type of vehicles that you may want to participate in. What differentiates us from a typical, what I'll call cheap beta or non-leveraged type of ETFs, the compounding impact of these trading tools you have to be aware of. These will track whatever leverage point for any given single day minus fund fees and expenses. But after one day, there's going to be compounding. These are path dependent. These are timing vehicles. These are not buy and hold like you might have for other non-leveraged ETFs, albeit if you own SPY or QQQ, there's going to be a lot of volatility to that too. You just may not have to be right in the short term like our leverage and inverse trading vehicles are designed for.
Now, what type of investor are typically buyers of your ETFs at Direxion?
They're short-term active traders that have a pulse on the market, that are staring at their screen all day, that have a high propensity for risk. These are high risk reward type of vehicles. So you have to have an appetite for risk. We see a lot of similarities between those traders that are using options, crypto, and futures, a similar DNA to those that use our leverage and inverse ETFs. But the key being, these are designed for short-term trading and that they have to be actively monitored on a daily basis, and they're not for everyone.
How exactly does leverage ETFs at Direxion achieve a 2 times to 3 times exposure on an index or a single stock? How does that work on a daily basis when achieving the 2 to 3x exposure?
First of all, Direxion has the pedigree and the experience in leverage and inverse ETFs. We've been in business over 25 plus years, creating leverage and inverse ETFs since 2008. And we've always had the mindset to seek to track whatever leverage point that individual ETF has on a given daily basis. So our leverage and inverse ETFs, again, are designed for short-term active trading. How we get the exposure to those ETFs, we, on a bull fund, for example, will own the underlying basket of stocks that make up an index, or the ETF that might track that index, the physical ETF, and then own what's called a swap. That provides the leverage within our ETFs. They're really an exchange, a daily exchange of payment between us and a global financial bank. We have a large breadth of global banks that provide us swaps, which provide the leverage. But we also have a portion of the portfolio on cash. And one of the things we look at, which is important for Direxion, not only the breadth of global counterparties to spread out the risk, the big banks, but also we have a risk team that's dedicated at looking at those underlying banks and making sure the creditworthiness is still there for us to trade with. So that's always something very important to us. And we have some of the largest, biggest banks that make up the counterparties for our swaps. Don't forget, these are ETFs. They trade intraday, and your liability is limited to your initial investment. So you can't lose more than you put in. Of course, you can lose profits as well. But, these are ETFs. So your liability is limited to your initial investment.
How do these products work from obtaining leverage versus going through, I guess, margin or even options, or some people obtain leverage through like credit cards and whatnot versus a leverage ETF at Direxion?
Well, it's a good question. For one, these are cost-efficient ways to get exposure to leverage. Relative to cheap beta, these are expensive. They're on average 95 basis points. There's some additional costs also in terms of the swaps that are embedded into the price. And when you look at it on a day-to-day basis, we track that underlying benchmark or single stock minus fund fees and expenses. So there's a cost-efficient way to get exposure to leverage. You don't need margin. Now with interest rates, who knows if they'll go down now after the Jackson Hole meeting, margin to obtain on trading platforms, depending on the size of the account, could be substantial. Here's a way to get leverage without margin exposure where your liability is limited. And then a lot of your potential viewers may have a bearish view and think the market might go down, or an inverse fund. Here's a way to do that in an ETF structure where otherwise most of your clients may not have the ability to short either a stock or a broader indice outright. Where there is also unlimited liability as well. Here, again, packaged as an ETF, your liability is limited to your initial investment. So this gives a lot more of the broader trading community the opportunity to utilize leverage or shorting within a package solution.
Now, can you explain how compounding works to benefit investors if the underlying goes up, but it can also hurt them if the underlying goes down? So can you explain how that compounding works for an ETF at Direxion?
Sure. Let's use a hypothetical example. Let's make it really simple for your viewers. You start with $100. You have a 3x bull fund. And let's say that underlying index goes up 5% the first day. So your 100 goes to $115. But on day two, unfortunately, that underlying index goes down 5%. So you lose 15%. After 2 days, you're actually below your $100 investment there. Why? Because you're losing on day two, 15% on that $115. A choppy market, just a simple 2-day example of something up and down the same, that underlying index, and you're under your initial investment. Now, let's take the flip side where the leverage works for you. Let's take that same hypothetical example, that same $100, a 3x bull fund. On the first day, the underlying index is up 5%, so you made 15%. So your 100 goes to $115. But on day two, you were lucky enough that the underlying index went up another 5%, so you made another 15% day two, and you're over that $130 because of compounding. So again, leverage could work for or against you. That's a simple 2-day example. In one case where the market's up and down the same amount on consecutive days, and you're below your initial investment, and the other is where the trend's your friend. You have 2 up days in a row, the same magnitude on an underlying index, and you're actually higher than you would think in terms of that 2x exposure. It's providing a little more than 2x exposure for you on your return in that other 2-day example.
With the inverse ETFs at Direxion, how can investors or traders use them as a hedging tool in their portfolio?
What we're seeing is there's different ways you could use it. It depends on the leverage point of the inverse ETFs. If you have a 2 or 3x inverse, you're going to have to really be on top of things because of the higher leverage point. It depends what you want to hedge. You want to keep that roughly that percentage hedge of whatever you're looking to do. You may need to rebalance that inverse more often and be very active with it. More often than not, we're seeing individuals use the 2 or 3x inverse as very short-term outright trades in terms of thinking the market's going down, or real short-term hedges on their longs. Where we're seeing individuals looking to utilize hedging maybe for more than a few days, but still have to monitor it every day, is our non-leveraged inverse ETFs. We have one on the S&P 500, SPDN. So that's just the daily opposite return of what the S&P 500 is doing. No leverage on it. And we also have leverage and inverse single stocks, a whole franchise of those, including the individual stocks of the Mag 7. We have 2X Bull, but we also have non-leverage inverse bear. Individuals have sizable gains in, the likes of a Microsoft or a Palantir, for example. Here's a way to maybe hedge that exposure with a non-leveraged inverse ETF. Still need to monitor it, but doesn't have the leverage of 2 or 3x. So maybe you could look at it from the standpoint of hedging maybe a little longer, as long as you're monitoring it again with the type of percentage that you want to have as your hedge within it. Keep in mind also, when you're trading leverage and inverse ETFs, the compounding impact, there may be some decay depending on the path dependency of that underlying index or single stock. But unlike an option, there is no time limit in terms of something expiring.
I have it on my sheet that it's called like volatility drag. Can you explain like what is volatility drag and how that affects an investor holding a leveraged ETF long-term versus maybe a short-term vehicle?
Well, for one, I'll look at it as different market scenarios where there could be a drag. One is in a choppy market where there's a lot of volatility, but not a lot of net movement. Look, for example, in April of this year, you had really a tale of two halves. The beginning part of April, you had Trump announcing that the tariffs, Liberation Day, and then you had him about a week later putting a moratorium on those tariffs. A lot of our bull and bear pairs were both down for the month of April. Why is that? Because you had extreme volatility within the month, both to the up and down side. So there's an example of that, whether it was semiconductor, SOXL, SOXS, whether it was our S&P 500 triple leverage, SPXL, SPXS, you saw that both in varying degrees were down because of the violent swings intra-month. So I think that's the best way to describe that, when you get a lot of volatility with not a lot of directional trend one way or the other. So these are timing vehicles, and the timing matters both on the entrance and the exit. So again, these are trading vehicles for active traders. These are not buy and hold vehicles. These are not for individuals that are not really looking at their screen on a day-to-day basis or have a pulse on the market and are ready to place a trade, whether to buy or to sell.
Where does Direxion see the most inflows for your ETF products? Long case, is it when there's a huge pullback in the market, they could get in at a cheaper price? Is it the bear cases when the market is at all-time highs and they could have maybe a sentiment of a bearish movement?
It's going to vary, but when you have markets at highs like they are right now, we tend to see people taking profits and selling bull funds, and in some cases thinking there'll be a reversal in the market and putting money to work in the bear funds. It's usually counterintuitive, not always the case. For example, if the market sells off, we tend to see more flows into bull funds. If the market's rallying, we tend to see more inflows into bear funds and outflows in bull funds, people taking profits. Keep in mind, just as an example of why I keep reiterating these are for short-term active trading, look at the trading volume of our ETFs in a given daily basis. You can have turnover of something that has multiple billions of dollars in it within a couple of days. So that's what they're designed for, short-term active trading. It's not to say you can't hold it past one day, but you have to know the risks. And like I mentioned before, the trend's your friend. You want something stair-stepping in your direction, no pun intended, where the leverage is going to work for you. The longer that narrative takes, the more likely it is that you could lose money. So that's why I emphasize that the timing matters.
I've noticed that at Direxion that the single stock leveraged ETFs can't have 3x on the leverage, but they could do 2x. Now the index-based ones can go 3x. So why is that occurring?
Well, there was a change in the regulatory landscape a couple of years ago. Any 40 Act ETF, previous to a couple of years ago, we could do a 3X version of it. So we're grandfathered on that. We have the largest lineup of 3X bull and bear products. More recently, when you look at the leverage inverse single stock space, which has evolved only over the last couple of years, the max leverage there, or any 40 Act product, ETF is going to be 2X. There's also single concentration risk with a single stock. You want to be aware of that. The leverage inverse single stock has really just been an extension of what we've been doing in the leverage and inverse space in ETF since 2008. Some traders want to get more granular. They want to trade off the headlines of single stock. So we have 23 pairs of 2X bull, non-leverage inverse bear of some of the most widely held liquid stocks that people want to trade. To that, we're about 40% of that single stock leverage and inverse space. So we're big size of that total space.
With the popularity growing in leveraged and inverse ETFs, why do you think that they become so popular in the stock market?
People are always looking to trade sectors or industries or broad indices. Single stock, if you look at them, people love to trade the Mag 7, anything AI related these days or tech related, semi related. Individuals want the opportunity to not just trade the broader sectors. In some cases, want to get more granular, trade the individual stocks, and they like to trade around pre and post earnings. And especially with the Mag 7, in particular Tesla, which is our most popular ETF, TSLL, which is the 2X bull Tesla. We're seeing a lot of ongoing interest there and a lot of headlines that people like to trade off of.
You guys have a broad arsenal of ETFs, both bull and bear, like sector equity, international equity, fixed income. I know you guys have those single stock names, even a gold product. How can investors look to trade these short-term movements with Direxion?
Well, yeah, first off, you have to realize how the ETFs work and the mechanisms behind them. One of the things we pride ourselves in is on our website, Direxion.com, is a dedicated section to leverage inverse ETFs, which include educational videos. I would recommend anybody, before they consider trading, to go to our website and make sure they understand how they work. And we described some of that today. There are different leverage points. Our fund names have daily within it because of the daily reset of leverage. We already talked about when you hold these past one day, the compounding that could work for or against you, depending on the path dependency. And also, all our fund names have the leverage point there. So whether it's 2, 3X or inverse 1X, you know what the leverage point is. You know that there's going to be commensurate risk with that. And then they'll also have the underlying index or single stock name within it as well. And bull or bear. Bull, of course, you hope the market goes up. Bear, you hope the market goes down when you're trading it. Now, in terms of sectors, our most popular sector ETF and our most popular ETF is the semiconductor, SOXL, the triple leverage bull on the ICE Semiconductor Index. We also have the bear as well, SOXS. Some of the sectors like financials, FAS, FAZ is our triple leverage bull and bear, or TechL, TechS, triple leverage on the tech sector. So those are some of the more popular sectors. And the broad indices, whether it's the U.S. with the S&P 500, SPXL, SPXS, which are a triple leverage S&P 500 bull and bear, or the small caps. If you want to trade TNA, TZA, which is a triple leverage bull and bear on the Russell 2000 as well. And then internationally, China's had a big run up this year. We have a way to trade that, the triple leverage bull and bear on the FTSE China 50, which is yin on the bull side, yang on the bear side. You mentioned gold also. Don't forget, we have the ability to trade gold miners. We don't have physical gold, so we have 2X in this case. Bull and bear, some of your clients may be familiar with GDX, GDXJ. Well, we have 2X bull and bear versions tracking that same underlying index that GDX and GDXJ track. So those are gold miners, junior gold miners. And by the way, look at the disparity this year in performance between gold miners and junior gold miners. It's been a good year for gold, but a fantastic year for gold miners playing catch up. And a lot of people like to trade leverage with the gold miners because they tend to have a higher beta than gold itself.
which leveraged and inverse single stock names at Direxion that have been posting earnings are seeing the most activity at Direxion ETFs?
We've seen some interest in a variety of them, but we've seen a lot of interest in the semiconductors. We have a number of semiconductors you could trade. Of course, all of the news, the geopolitical news regarding that, the tariffs, the security issues with what's going on with China, with NVIDIA, with the H20 chips. So we're seeing a lot of trading around AMD, Micron, Taiwan Semi, Qualcomm. So we have a number of different semiconductor single stock bull, 2X, bear, 1X that you could trade. It's interesting also, Eli Lilly, for example, had earnings recently. Stock sold off dramatically. We have a 2X bull, an inverse bear on Eli Lilly. So we saw a lot of flows going into 2X bull on the dip, which was ELIL. Palantir this week, for example, major pullback from an intraday high to low. I think was down about 20%. It's recovered a little bit. It's holding right around its 50-day moving average, but we're seeing a lot of interest in the 2X bull and as well as the bear at times, PLTU and PLTD. So a lot of interest in semis, AI, and it really depends on the market environment in terms of what tools they're using, whether bull or bear in those.
Now, are there any leverage or inverse ETFs at Direxion that you think will garner the most attention? So maybe ones that you think might be, I guess, popular in the future for single stock names, as well as the ones that are single stock outside of the Mag 7.
Well, there's certainly, Palantir comes to mind as we mentioned outside the Mag 7. Some of the semiconductor stocks, as I mentioned, outside the Mag 7 as well. We do have defense names like Lockheed Martin and Boeing that you could trade as well. That there's been a lot of interest in defense stocks this year, for example. So we have 23 pairs right now, and I'm sure we'll consider adding additional ones where we have the appropriate liquidity and capacity to do so, and where there's interest, regardless of what the sector might be. In terms of what the broader market on the broader indices side, you've seen a little bit of a recovery in healthcare. That's been something that has been underperforming. So we have Cure, which is on the select sector healthcare industry. Some interest there on short-term trading activity pick up a little bit. But as I mentioned, the broader indices, as well as some of the sectors that have performed well, like tech and AI, semis, we continue to see interest in, as well as the financials. It'll be interesting to see what the Fed does in September. It looks like now Powell has tipped his hand that it looks like they'll be cutting. What's that going to do to the financial stocks? It'll be interesting to see people trading the bull and bear. We also have the regional banks, that you could trade as well with DPST, which is a triple leverage bull on the regional banks.
Why do you believe gold and subsequent gold mining stocks can continue to rally in a risk-on environment?
They're related, gold and gold mining stocks, as I mentioned, but of course, one's the equity itself, one's the physical commodity. Let's look at gold. Despite the fact that it's been mostly a risk-on environment this year, gold continues to rally. Some of the reasons why is really central bank buying, nervousness about their underlying currencies in some cases. Also, when you're looking at gold as a diversifier within a portfolio, and with the market at all-time highs, I think people are looking for that level of diversification. From a short-term basis, the gold miners, as I mentioned before, the stocks have a higher beta associated with them. So they're good trading, they're ideal trading vehicles. We've seen more inflows in the bear products this year than the bull. We've seen profit taking in trading the 2X bull gold miners, junior gold miners. So some outflows there on the rally, selling on the rally, and in some cases looking to go inverse with the miners themselves. But again, all our vehicles are on a short-term basis. When you look at gold also, the one other thing I will add is that the dollar is weak this year. That tends to bode well for physical gold itself because it's priced in dollars. So that's another thing to look at when you're looking at gold prices, and will it have an effect on gold miners as well?
I've noticed that Direxion ETFs has become one of the leaders in this space. Now, why do you think that Direxion is at the forefront?
Well, a couple of things. One is our pedigree and experience. I mentioned that before. We've been in business since 1997, and we've been trading leverage inverse ETFs since 2008. We're one of the pioneers in the space. The breadth of counterparties that we have to be able to track those underlying benchmarks and try and meet those objectives. We're a $50 billion plus shop. Puts us in the top 20 of all US-based ETF providers in terms of AUM. So we certainly have economies of scale. And the breadth of our products are really unmatched in terms of the leverage and inverse single stock space. When you look at us, we have a broad array of leverage points from 3x bull and bear to 2x bull and bear to inverse 1x bear in a broad variety of different broader indices, industry sectors, single stocks, as I've mentioned before. So it's the breadth of products, the different types in terms of the leverage points that really make us unique, and our expertise and experience and our size. At the end of the day, one of the things I've noticed is there are a number of boutique ETF providers that are in the marketplace that are coming out with maybe single stock ETFs. I'm sure they're good shops, but we're one of the few firms that have economies of scales and can work with the biggest global banks out there. And I think that makes a difference in terms of our ability to track and meet our objectives day to day.
What's some common misconceptions that you think people have about leverage and inverse ETFs?
If you hold these for a period of time, that all you need to do is times that underlying benchmark or single stock by whatever leverage point, and that's your return over time. So they need to understand the leverage and the daily reset of leverage. There's going to be compounding, and that it'll track for any given single day. But after one day, there's going to be compounding. So I think they need to have an full understanding that the timing and path matters when you're trading these vehicles, and you can't just multiply by 2 or 3, whatever the leverage point is, and look at an underlying index over a 3 to 5 day period. You hold it and expect that return. So these are path dependent, and they have to be aware of that and the mechanisms of how they work.
Risks of a leveraged ETF, because I know some investors might look at SOXL, for example, and look at the all-time return. If you just bought it since inception, you would be up quite a bit. Now, the question is, why can't a leverage ETF, like something like SOXL, be a buy and hold investment? Because when you look at the chart, you're seeing those high returns versus the overall market.
Yeah, it's all about timing. I mean, if you cherry pick, maybe, if you time it perfectly, of course, the leverage could work for you. But I don't have impeccable timing. And the fact is, with what we mentioned, markets go through cycles, ebbs and flows up and down. Nothing goes straight up forever, nothing goes straight down. So that's why these vehicles aren't designed as buy and hold type of vehicles, unless something goes straight up indefinitely. Now, I don't have in front of me what that return was over the time period. But the thing is, if you're holding these for any length of time, and certainly I wouldn't recommend for the time frames that you're talking about, because the market's going to have different cycles to it, and it's going to impact your return. And would you want to take 3x risk to get much less than 3x over time? I don't think that's prudent. So these are short-term trading vehicles. Now, how long you hold those is really up to the individual. I look at it as every day is a new day. And if something's trending in your favor, that's what you have to at least assess. If something's choppy, do you decide to cut your losses and trade again? Or if something's going against you with the magnitude of leverage, depending what it is, you could lose a significant amount of money in a very short period of time. Just ask anybody that traded on the bull side for the first couple of weeks of March 2020, for example. They can tell you that for sure. So timing matters. If the market's cooperating and stair-stepping in your direction, that leverage could work for you. But if it's a choppy market or something's going against you, if anybody's trading, they have to have a high risk tolerance and can accept losses as well.
Are there any liquidity concerns with leveraged ETFs at Direxion, especially during very volatile market environments?
I look at it as it's all about the underlying. Everything that we provide exposure to is an underlying equity indice or treasury or a single stock that's broadly traded. It's really, to me, all about the underlying. Now, in certain volatile markets, do you want to be aware of putting in limit orders, for example, or looking at market price versus what's called the fair value or the NAV? And if it's trading at a discount and premium, that would be the case, whether it's leverage or non-leverage products. So when it comes to ETFs, so somebody should be cognizant of that. We have on our website every night what the market price closed at relative to what the fair value or what it should have traded at. So those percentages you should look at. Most of the time they are nominal, but in some cases when there's a lot of volatility in the market, those discounts and premiums could be a little more significant, and you want to trade accordingly, whether it's a leverage product or a non-leveraged ETF product.
How does current interest rates affect the overall cost of leveraged ETFs at Direxion?
Well, what rates are right now, with any bull fund, for example, it's going to negatively impact it a little bit in terms of the costs associated with that. But the bear fund's the flip side of that, where it'll be a positive. Regardless, these are all net of fee products you could see on a day-to-day basis that is pretty much tracking that underlying index or single stock, for example. And we have cash on hand also. We don't need to put all of it to work to get that leverage exposure. So there's a lot of cash on hand, particularly on the bear side. So again, it's another way to defray the costs associated with the leverage. I still think this is a cost-efficient way to get exposure relative to other ways to obtain leverage. However, if you're comparing this again to a non-leveraged ETF that's more buy and hold, of course our fees are going to be higher, but they're trading tools and they're not designed to be held long-term. So when you take that into account, I think there's a cost-efficient way to get exposure through a packaged ETF, as I mentioned before, where your liability is limited to your initial investment.
Now, how does Direxion balance innovation in this space, coming out with new products and new ideas, with the responsibility of making sure investors understand the risks of leverage and even inverse ETFs?
Well, that's something, if you go to our website, any of our materials, front and center, and right there, it'll say that these are designed for short-term active traders, and these are highly risky vehicles, and that they really should not trade these until they have an understanding for them. And I think I've been here 14 years, and that message has been consistent. That's been our mantra. That's the most important thing. People are going to trade them, and we want them to, if they have an understanding of those products, understand the risks, and are truly traders. Because again, these are not buy and hold vehicles. So I'd recommend to anybody that is considering trading our products is to go to the website and get themselves educated before they decide to trade any of these vehicles.
What guidelines would you suggest for somebody who wants to know how to responsibly use leveraged ETFs at Direxion? Now, I know you said go on your guys' website and look at the educational videos that you guys provide, but what's your take on how to responsibly use these leveraged ETF products at Direxion?
Know the risks associated with them. Don't lose more than what you're going to be comfortable with, because of the fact that they can provide large gains, but they could also lead to significant losses in a short period of time, depending on the leverage points. So again, these are trading tools. I think people have to understand that and use them responsibly, like anything else. That's really would be my message to anybody that is considering trading our products. And in fact, education should be something first and foremost that any of your investors or listeners are going to consider, regardless of whether it's a leverage vehicle, non-leverage vehicle, whether it's options, futures, crypto. You should know the level of risk and understand something before you're trading it or investing.
Where do you see the future of Direxion when it comes to new ETF products and just the team at Direxion? And what makes you so excited to wake up every day and be a part of Direxion?
Well, certainly the evolution of having trading tools and the breadth of those now that we have available. Most recently, the last couple of years, the leverage and inverse single stock. So we're always looking for innovative ways for the active trader to get exposure that they may not have currently. So that's one side of our business. But the other side of our business is more for the non-leverage or strategic asset allocator. We actually have a few products that have been in the market for quite some time and have some sizable assets to them. That includes our equal weight NASDAQ 100. That's over $1 billion, QQQE. So it's really the antithesis of our leverage and inverse lineup. This is more strategic asset allocation. The Mag 7 and the top stocks in the NASDAQ 100 and S&P 500 have really led this market for quite some time. But people want to diversify within their NASDAQ 100 exposure and have an equal weight, where the top stock will be the same weighting as the 100 stock, for example, at 1%. We also have a commodity strategy that is rules-based tactical strategy, COM, C-O-M, aptly named. It's a broad basket of actual commodities. It's a little bit different than some of the passive commodity broad benchmarks that are out there, like the Goldman Sachs Commodity Index or the Bloomberg Commodity Index. It'll be long a commodity if it's showing a favorable price trend, but in cash with the commodity if it's showing a downward price trend. So it's a good diversifier for those that are looking for something that doesn't correlate highly to stocks and bonds. So we're going to look for more of those type of products too, and bring it out in the marketplace where we could differentiate.
I'm going to throw it back to you on any final words you have about leveraged ETFs, inverse ETFs, and just everything about Direxion ETFs.
Just to, go to our website at direxion.com for any further details. You could also give us a call. You'll see on the website our phone number there, and educate regardless. Find out if these are appropriate for you, and if you do have any questions, you can always give us a call as well. But the most important thing is to be prudent, and for those that really like to actively trade and are looking for a magnified exposure to express a view, these are the trading tools that you may want to look at.
Now, thank you so much, Mr. Edward Eglinski, a managing director at Direxion ETFs. Now, if you guys like this video, please give it a like because of this cute puppy did. And don't forget to check out our last interview right here on your screen. I love you guys so much. Crushing the stock market. And take it easy. Peace.
Thank you.